Good evening, all. A very warm welcome from MK Investment Managers family. Thank you for taking the time out of your busy schedule to attend this webinar. In today's fast moving and often unpredictable financial landscape, markets tend to react sharply to news flows, global events, and short term triggers. In such an environment, it becomes increasingly challenging for investors to stay focused on long term wealth creation. This brings us to the theme of the today's session, which is the discipline of capital building in a reactive world, turning uncertainty into structured growth. The idea is simple yet powerful. While markets may remain reactive in a short term, successful investing is rarely about reacting. It is about maintaining discipline, following structured approach, and staying committed to a well-defined investment philosophy that can navigate volatility and convert uncertainty into opportunity. To help us decode it and deeper and share deeper insights on the current market outlook, we are privileged to have with us our executive director and fund manager, Mr. Sachin Shah, who brings extensive experience of over 25 years and a strong track record in navigating diverse market cycles through his strategy Capital Builder, which has demonstrated strong and consistent performance even during challenging market conditions. A warm welcome to you, Sachin sir. Over to you. We would like to hear you from.
Sure. Thank you. Thank you, Pritam. Thank you so much. Thank you, all the participants. A very warm welcome to all of you. Uh, so I have a presentation, and then of course we will have this. We'll make this session very interactive. But what I'll do is that we'll start with the presentation, and my presentation has been, we've tried to make it as much comprehensive as possible, making it very inclusive from the current environment that we are in today and what are we looking forward. We will also talk some bit about our investment philosophy in for our capital builder strategy, which I and my colleague Kashyap Javeri has been managing. So I'll just start with the presentation. Yeah. Yeah. So I hope it's visible to all of you. Pritam, it's visible?
Yes, sir, it's visible.
Okay, great. Thank you. So, guys, as you can see out here, I think the most important line of this presentation is, and after the difficult time that we've had in the month of March, and I think overall, even if you say the entire FY26 and to some extent even FY25, because over the last 2 years, as all of you understand, that Indian equities haven't delivered more than single digit returns. So I think we've had some time correction, we've had some value correction, all of that has actually played out. And of course, then we had this geopolitical tensions, particularly with this Iran, Israel, US, Middle East challenges. So clearly, after all of this, where do we stand today? So from that perspective, we clearly believe that the worst is really behind us. And why do we say this? As we move ahead in the presentation, we will deep dive into a lot of data points which are clearly indicating that the times that we are going to look ahead is going to be much better. So if you just see from the domestic demand side, clearly a lot of factors are moving in the right direction. Similarly, on the global growth side also, and I think most important, valuations. Like as we say, is it in the price? And as we say, everything is good at a price and everything is bad at a price. So we strongly believe that today the valuations are such, along with the catalyst in terms of a lot of macro factors, a lot of bottoms of developments that have happened at the economy level, both domestic and global. Clearly, we feel these are very good times to actually increase allocation to equities, or if somebody is really thinking of investing over next 2, 3, 5 years. I will now just move to some of the next few slides where we will deep dive into some of these data points and you will get a good sense. Yeah. So, Pritam, has the slide moved for you guys?
Yes, sir.
Great. Thank
It's
you.
to the next slide.
Okay. Okay, guys. So as you can see here, what we are saying is that if you look at the overall Indian economy, even in the month of March, which was not a very easy month, if you see the PMI data, which is one of the most high frequency indicators, it has shown a lot of strength. It is at 53.9, which is very, very good. What we've also seen is similar for the global markets, whether it is US, whether it is Western Europe, whether it is China, whether it is Japan. And as we move ahead, again, I will share some of the data points with you. I think the other very important thing is that in terms of our macros, today the Indian economy has nearly $700 billion of forex reserves. So we are in a very, very strong position. Yes, we've seen some bit of rupee depreciation, and I would think that has been a bit of an acceleration, more to do with the sentiments. But fundamentally, I think we are very strong. And of course, then we saw some action coming from RBI to hold the speculation. And my personal sense is that we are overdone as far as the rupee depreciation is concerned. We may see some bit of reversal in the next 3 to 6 months. And if not a reversal, then I think you may not see any significant depreciation or even a marginal depreciation from here on for at least next 2 3 years. So the annualized depreciation rate of rupee over dollar about 2 3%. I think it's already got factored for at least next couple of years. So either it's a little ahead of time or it will correct itself in the next 3 to 6 months. So don't be surprised if actually rupee gets a bit appreciated and if it is below sub 90 levels versus the dollar, right? And again, I think another very important data point that everybody talks about is that there has been a significant amount of foreign investors selling in the domestic markets. Yes, that has been the case. As you can see the data out here, they sold nearly 3 lakh crores in the last financial year. And of course, a significant part of that was in the last quarter of January, February, March. But I think, yeah, it sounds like a big number, but I think we have to always look at things in the context, right? So the way I think about it is the context today is what is the domestic liquidity to absorb that? And you can clearly see it is far, far more bigger, stronger, very, very broad based, because you can see the DII inflow, which is domestic mutual funds plus insurance put together, actually invested more than 8.5 lakh crores. Now that's like literally $10 billion in one financial year from the domestic investors, and a good part of that came from the mutual fund SIP. Almost, I would say, 30 to 40% of that. So, which is where this is extremely, extremely broad based. This is very, very sustainable. Nobody should think that this might be a just one off or this might not sustain. But because the average ticket size in SIPs are of about 2,000, 3,000 rupees, which is an annual investment of 50,000, 60,000 rupees. So, and with that, if you are coming with a flow of 3 lakh, 4 lakh crores, and cumulatively with insurance almost like 8.5 lakh crores, it's a very significant amount. And as we move to some of the next slides, we will again see that even in the month of March, when the index was down almost 11, 12, 13% across the board, all the indices were down in just about, more in the range of 11 to 13%. The investment side, the investing from the retail Indians has not actually halted at all. In fact, it has got even further accelerated. So I think yes, there will be volatility. There is no doubt about in that for at least next maybe in the near term. But I think if one has to take the next 12, 24, 36 months, we clearly believe that this is great platform, or this is a great base to actually see how things are going to move ahead. Uh, just deep diving further bit how some of these domestic demand factors are moving. So, Pritham, you can see the third slide, right? The domestic demand,
Yes, sir.
the digital payments.
Yes,
Okay,
it's
great. Yeah.
visible.
Right. So if you see out here, clearly, if you see most important to my mind, one of the most lead indicators for any economy is always the auto volumes, right? And particularly when it came to Indian economy, the big bang reforms in terms of the GST cut, which came sometime in August, September, has actually revived the entire domestic demand, both on the rural and the urban side. Because as you can see across the automobile categories, whether it's two-wheelers, three-wheelers, four-wheelers, passenger vehicles, tractors, and even commercial vehicles, there has been a significant YOY jump. So if you just see the second half of FY26 versus the second half of FY25, we have seen a significant amount of jump across. I mean, the growth rates are in the above nearly 20-25% across all categories. And as you can see that those growth rates in the first half were fairly muted. So this GST cut has been a big catalyst. So, from the policy side, the regulators have been actually creating a great environment for the overall demand, factors to keep on driving, which is also reflected in some of the digital payments, in overall credit card payments, in all kinds of payments that we track, which are available in public domain. It is clearly reflected that the domestic economy is extremely vibrant. If you see some of the other factors also, like the e-way bills, right? Because this is again a very important factor which continues to grow in high double digits, literally 15, 17, 18, 20% for the entire FY26. So that has also been very, that's a very good lead indicator, and it shows very, very strong signals in terms of the ground level realities. Even petroleum consumption products, which also is a reflecting of in terms of how the economy is moving in terms of the demand side, both for the industry and also the auto side. Again, there most of the products have been showing decent amount of growth on the volume side, and of course the overall PMI continues to be also in the above 50. So any number above 50 will always look good, and of course India stands out over there with 54 versus so many other economies in the world. But even other economies, like I was mentioning, whether it's Western Europe, UK, Germany, or whether it's US, Japan, China, across all of them are it's they all are at above 50, which means they continue to grow well even in this challenging times. Uh, this is what again I was talking about in terms of nearly 17 of the 20 global countries continue to have this very, very good PMI, which means that at the ground level, the consumer demand continues to be fairly resilient. The consumers have not kind of had any challenge, I mean, very serious challenges as far as the consumption is concerned. So this is what really helps us in understand how the domestic demand, how the global demand is actually moving, and we can clearly see that things are in a fairly, I would say, I mean, they are going in the right direction. I think now the most important thing here, and I'll spend a few minutes here because this is really very interesting. Our head of research and my co-fund manager Kashyap Javeri has actually figured this out very brilliantly. So if you see, one is the valuations chart, or the line graph that you can see out here. So, we are at just about 21 times. In fact, we did touch some almost 20 times in sometime mid-March or so. But even today, after the bounce that we've seen in April, I think we are at just about maybe 21 or 21.3 times in terms of the Nifty earnings, which is a very, very reasonable. So most part of the froth, as you can see, which was there at some point in time, we would have been at probably 23, 24, or 25 times. So most part of that froth has actually got out of the system, and this is what I was alluding to earlier, that we've seen decent amount of time correction and also a value correction, right? So both prices have corrected, and also with the time value there has been a decent amount of earnings growth. So I think that is something what is really giving us a lot of comfort, that most of the negatives are in the price. And from here on, it's not that we have only positive news and all of that, but I think a lot of that is already factored in the price. And like as they say, markets always will keep on climbing the wall of worries. That is how we see, at least for the near to medium term, and over a period of time, a lot of these macros which are probably turning around to get into the positive zone, which will also become very solid over the next 6 to 12 months. And then again, markets will have a very strong rally over the next 2 to 3 years. So we believe that current valuations are very, very attractive. The other very important thing that we internally always keep on discussing is the relative valuation of equities versus the bond yields, because finally overall financial markets is an arbitrage machine, and investors always have the option of investing in fixed income versus equities as an asset class. So today, say for example, the bond returns are in the range of about say 6.9 to 7.2, that range, and equities at about 20 to 21 times is trading in the range of 4.5 to 5% yield. So the gap between the two is just about maybe 200 bips. But of course, in equities, you have a long runway of growth over the next 3, 5, 7, 10 years. So typically, what we have seen is that whenever the 10-year GSEC yield and the equity earnings yield, whenever the gap is less than 50 bips, which is what it is today as we talk, is just about maybe under 220 to 230 bips to 2.2 to 2.3%, nearly 60 to 70% of the times it has actually bounced back. So actually less than, I would say, 25 to 35% of the times it has traded like this, right? So that really tells you that these are one of the few times in terms of the valuations where you are getting a good opportunity to actually allocate money to equities. That is something how, and similarly when you compare to even a 364 versus a daily yield and all of that, everywhere we are getting a lot of comfort as far as this valuations are concerned. Whether you look at standalone P ratios, whether you look at relative valuation to the bond yields, we are in a very, very sweet spot is how we are thinking about it. Again, as I was mentioning earlier, there is enough amount of liquidity which is also helping the equity markets, and which is why we have seen this kind of jump in the month of April. Because in the month of March, when markets were down, very, very significantly, the retail investors did not run away. In fact, they did not even shy, and they actually allocated more money. Even not only the SIPs, even the lump sum money was as high as 52,000 crores at a gross level. At net level, I think we had nearly 40,000 crores of inflow in the month of March from the domestic mutual funds. And I think along with that, what we've also seen is that the selling intensity of the foreign investors has also reduced significantly, not only in the fag end of the March, but also sometime in the month of April, which is the first half of April. If you just track the daily numbers, clearly the selling intensity of the foreign institutional investors has reduced very, very significantly. Uh, so from all sides, what we believe that clearly there is a case where you believe that the probability uh, making making a good investment at this juncture is actually very, very high. Uh, and again, from if you see how we stand today, because I think there is this one big apprehension in the minds of many, many investors that because of this war, how is the Indian economy standing today? How is it going to impact us? So I would say that yes, there will be some impact. There are supply chain disruptions which may impact for a quarter or two at the ground level. But the point is that today we are in a much, much better position to cope up with this, right? So if you just look at in terms of the today the inflation data, I think as most of us have grown up over the last 2 decades or last 2.5 decades, I mean, to see an inflation with low single digits of just about 3 4%, is a new India, because we've always seen inflation in the range of 5, 6, 7%, and sometimes even it has a 7.5%. To to see that RBI's target is 4% and actual inflation is significantly below that, it's a very positive surprise to me at least. So I think we are in a good position there. We have fantastic forex reserves, almost 11, 12 months of our. I mean, today we have $700 billion of forex reserves. Our gross import number, annual number for FY26 was just about $600 billion. So assume that we have no exports, no services exports, no trade exports. Still, we can easily just absorb the entire imports for at least full 1 year, right? Liquidity is something what I clearly discussed with you. Even on the FDI side, I think that's again a very interesting thing, because a lot of people believe that FDI has been zero negative for FY26, but that's a lazy way of actually evaluating it. If you look at the gross FDI number, they have been very strong at 70, 80 billion dollars. It's just that because the secondary markets were so strong, the equity capital markets were so strong, that a lot of private equity funds who have invested in some of these new age businesses or even in other businesses, they actually got an opportunity to exit during the last 2 years when the markets were fairly buoyant. So, they have actually booked profits for their investments that they did over the last 3, 5, 7, 10 years. But think and what I understand is they have actually exited nearly $40 billion worth of secondary market exit from their original private equity investing. Now think about it this, that once these investors have got this kind of success, the kind of the confidence that it will create in them for the Indian economy, that this is a place where they can invest in businesses, and this is a place where they can bet on entrepreneurs. This is a place where the entrepreneurs have actually scaled up businesses. This is a place where economy has the potential to create such large businesses, and most important, after all of this success, the capital markets have the breadth and the depth to actually give them this super exit. Now, when this kind of confidence that creates, it is just a question of time. It's not about if, but it's just a question of when they will actually invest 10 times more money in this economy, because they have tasted the success, and they have tasted success like nobody's business. They have made some super money in some of these new age businesses. Of course, they took the risk, they understood the potential, but that's one side of the story. The other side of the story is the potential actually getting capitalized. And once that happens, the global investors, the confidence that they will have to invest in actually FDI is going to be at a different level for the next 3, 5, 7, 10 years. So we are extremely positive as far as FDI investments are also concerned for the next 2, 3, 5 years. I think another very important thing, I think interest rates continue to be very stable, thanks to decent inflation that we have, thanks to the government fiscal deficit management, and also the monetary policy by the RBI. Again, when we look at some of the domestic economy lead indicators, so like I mentioned earlier in terms of the auto numbers, I think the other very important lead indicator is always your how the banking system is doing in the country. So as I'm sure some of you already know this, but if you see for the entire FY26, we had a decent loan growth of almost 13, 14%, which is a very healthy growth. We had a decent deposit growth of almost 12, 13% at an industry level. And some of the leaders within the industry, whether it is private sector banks or even within the public sector, all of them have delivered or have been delivering at least till third quarter, and some of them who have delivered the full year FY26 results also, they have delivered very solid results, be it asset quality, be it growth, be it profitability, and be it their confidence for the growth in the next in the current financial year. I think all of that, there are only green flags. It is in fact becoming challenging for analysts like us, for professional investors like us, to find any red flags in any of these in the financial services today, particularly the mainstream large private sector banks or even some of the public sector banks, they all have been delivering growth. They all have been delivering good quality. They all have been delivering good profitability, and their confidence to grow for the next at least 12 to 18 months to 24 months is again very, very strong. And both on the retail side and also on the SME sector, wholesale side, all the three lending side of the businesses are actually doing exceedingly well. So clearly today Indian economy is in a much, much better shape. Uh, of course, this presentation would not be complete till we actually discuss about the current geopolitical challenges. Uh, all of you have been fully aware about it, how things have been moving. But I think one thing is very clear: the worst is over. Both the countries, whether it is USA, whether it is Iran, they are clearly looking for a solution. World is looking at them. We are also seeing now intervention from many other countries trying to play a role of catalyst to get this sorted. So our sense is that even straight, which is closed right now, closed, open, I don't know what it is, but it is not normal. I think it is going to become what it was sometime in January 26, February 26. So in that normal scenario, sooner rather than later. So it's just a question of maybe now few days at best, maybe 1 or 2 weeks. Uh, I think everybody is very clear that this is just a question of now. It can happen any moment, right? So our sense is that today the biggest challenge that Indian economy has in terms of oil prices, I think that also will get sorted very quickly as soon as there is normalization in the Strait of Hormuz. As soon as that happens, plus I think as a country we have also evolved. We have now many other sources of fossil fuels, plus over and above that, as a country we today also have, over the last so many years, thanks to our government policies, our dependence on fossil fuels has also reduced, and we are now more on the renewable side. In fact, some of you may be surprised to know this, that of our power generation capacity, nearly 50% today is now renewables. And of whatever power units that we generate, as of today, nearly 25% of that is now from renewables. So that kind of de-risking has already happened. And even more important, over the next 3, 4, 5 years, will this 25% of the generation, can it go to 50%, 60%? High probability. The kind of the investments that we are seeing, both on the solar, wind, again, a lot of technologies as far as the battery energy storage systems are concerned, all of that is actually accelerating. So we are very confident. And again, I think as soon as the oil prices come down to in the sub $80, I would say Indian economy will be out of the woods as far as this oil prices are concerned. And our sense is that this should happen sooner rather than later. So again, just to cap, what we discussed so far, inflation has been very much under control. PMI, Purchasing Managers Index, is also looking very strong. Forex reserves continue to be strong, and current account deficit, which is again reflecting, as I mentioned earlier, in terms of the government fiscal deficit, and also our import and export versus, and also, I think very another important thing is that on the current account deficit, our services actually have been growing very, very strong. So that has also helped us significantly to whenever there is a spike in oil prices, and when we have a net dollar significant net dollar outflow because of higher oil prices, that has got, I would say, buffered by the services growth that we've had, so export services growth that we've had. Globally also things are not so bad, as we saw in some of the earlier slides. uh, I think 10-year GSEC, which had India 10-year GSEC, which had gone to as high as 7.2, has now receded to in the range of 6.9%. Corporate bond markets are also functioning very, 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 very stable. Domestic flows continue to be very strong across the board. So I think overall things are in a very, very decent shape. There is no panic. in capital markets, come what may. The most important thing is that we have avoided panic, and if at all there was some bit on the currency side, again there I think regulator has taken very proactively some of the steps and has sorted things out there. And otherwise also, as I mentioned earlier, I believe that the Indian rupee depreciation has got accelerated a bit ahead of time. We may see some reversal, or there will be time value, and probably we will not see too much of depreciation over the next couple of years from these levels. As far as the markets are concerned, I think one will have to be very selective across the board. Of course, there will be certain sectors, and of course, where we can be overweight. But most important is that in the environment that we are, quality is going to play a very important role. One will have to be extremely resilient. Balance sheet quality, pricing power of these businesses, all of this will now have to come into play, because as I mentioned earlier, there has been impact. There will be supply chain disruptions. There may be certain pockets where demand is also impacted. So now it is going to be the companies which will have to show the right to win, and companies which will have the right pricing power, companies which will have the right balance sheet to be resilient in this kind of environments, companies which will have the right processes, that will all come into play. And again, we may see some unorganized to organized market share moving, or at least in some of the industries we are already seeing that, because organized players have this wherewithalness for this kind of challenges, and they tend to actually gain market share in this kind of an environment, which is where we are always focused about. Uh, as sectors, we clearly like, if you see among the early results, private sector banking has done very well. We also believe that pharma and healthcare will continue to be extremely resilient. I think on the autos and some of the discretionary consumption, if we were in the month of March, probably we were a little concerned because of the challenges. But I think the way the geopolitical situation stands today, we clearly believe that those headwinds have now converted into tailwinds. You've got decent valuations of some of these businesses, and we also believe that the domestic demand continues to be very healthy over there. So we are not overly worried at all across the board. Now, just moving to some of our, just to share with you our MK Capital Builder Strategy, which I've been managing for now 13 plus years. I've been managing this since 1st April 2013. As you can see, over the last 13 years, we've grown the money more than 6.5 times. And this is after the March fall. So if you would have checked this return sometime in January, we were almost 7 times. Uh, Overall, I think we've done about 15% plus compounded over these last 13 years, and we've done a decent alpha across both BSE 500 TRI and Nifty 50 TRI, as you can see from the table. So it has been a very good journey, I would say. But more important is, how what has been the experience during this journey, because what really helps investors to stay for the full journey and reap these entire benefits is, I think, the quality of the portfolio, is the volatility in the portfolio, the risk that we have managed in the portfolio. I think these are some of the very critical things that we would like to share with you. So this is the full portfolio out here, and as you can see in this slide, should I expand this a little bit, Pritam, or it's fine?
It's visible, sir, but if it's better if you could expand it a bit. Yeah.
Yeah. Okay.
Now better, sir. Yeah.
Okay. So as you guys can see here, uh, we have nearly, it's a very high compounding portfolio. It has a very long-term track record, and you can see nearly 80% of our portfolio is now 7 to 12 years of vintage. So we have actually invested in very, very high quality businesses. We have allowed them to grow, and it has reaped fantastic benefits to us. So not only we've delivered very good alpha, not only we've delivered very good 15% plus compounded returns, which is definitely more than two times the risk-free returns that are available. But I think more importantly, as a byproduct, it has also been a very tax efficient product, as our actual tax payouts have been very, very low, because most of our gains have been not only long-term capital gains, but they have continued to compound. So we don't have to actually, pay taxes when we are not booking profits in a hurry, right? So overall portfolio turnover ratio has been under 15%, which saves a lot of transaction costs. There has been no leakages as far as the tax payouts are concerned. So all of this has actually played out, and it's a very well diversified portfolio where we manage risk, where we manage weightages across the sectors, across bottoms up, in a very, very disciplined fashion. I think another very important thing is, if you see for us, how have we actually done versus the industry, and particularly the flexi cap mutual funds or the large cap mutual funds. So if you will compare to that, we continue to be in quartile one across time frames: 1 year, 2 year, 3 year, 5 year, 10 year, 12 years. And you can see how we've delivered, even in the last 2 years when it was difficult. We've generated an alpha of more than 6% on a compounded basis, on a 2 year basis, on 3 year basis also. We've delivered almost 300 to 400 bips of alpha. And again, if you compare it to the flexicap mutual funds average, mean, median, and we've taken the full universe of the flexicap, all the 39 schemes, we've not excluded anything. And when we take the mean and the median of those strategies, you can see how we stack there. But again, this is only one side of the coin. This is only the returns. The important part is also the other side of the coin, which is how have we managed the risk. So again, when you look at the risk adjusted returns, we are even more superior across the board. So you can see how our beta has been, it has been always consistently in the range of 0.85 to zero point 0.9, versus the industry at 0.95, and of course benchmark at 1. Our standard deviation has always been below the industry and also below the benchmarks. And thanks to that, our Jensen's alpha, which is one of the important ratios, I think, from a risk adjusted return perspective, looks very, very solid across time frames. It's not that only in a particular time frame, but whether it's last 2 years, 3 years, 5 years, 10 years, 12 years, across the time frames, it is looking very good. We've done something similarly for, I mean, what I showed you last slide was on the mean. Even if you look at the median of the flexicap mutual funds, it will look very, very similar. So in fact, mean and median is not very different for the industry, and we tend to stand out against that also. Another very important thing is, if you look at the information ratio, I think very important ratio which SEBI has now made it mandatory for the mutual funds. So we've done it for our strategy also, or for our PMS strategy, which I've been managing for last 13 years. So again, there, if you see over the last 1 year, we've done well. If you look at an up capture, down capture, and overall, we tend to actually do much better, which is what I was trying to tell you, that the journey of the investor has been very, very smooth. There has been no major negative surprises for investors. We manage the risk side equally well, because it is very important that over 3 years, 5 years, 7 years, when we see this kind of compounded returns, investors stay with us for the journey. And for investors to stay with us during this whole journey, it is very critical that they actually feel comfortable, not only when they look at the portfolio construct, which is the names that I have showed to you, because the quality of the portfolio, the businesses that we invest are very, very high quality, but also in terms of the volatility of the NAVs. If that's not very sharp, it allows the investors to actually, stay the whole course, right? So similarly, 3 years since inception, across the board, all our numbers are looking very good. So we just thought we should share some of these points. Uh, and now finally, just to sum up the whole thing, if you see, what we discussed is that clearly the worst is behind us. We believe that today Indian economy is in a much, much better shape and much more resilient to absorb all kinds of shocks that we've witnessed in the last, I would say, 1 to 2 months. And of course, the worst seems to be now behind us. So it's not going to be derailing the Indian economy's growth. It's not going to be derailing Indian corporate growth. The macros are really supporting. And again, the most important, as I keep on saying, because after quite some time, we feel that the valuations have become very, very reasonable. Of course, what can change this? If suppose the Strait of Hormuz doesn't open up for next 3 months, if the war gets worst from here, yes, those are some of the downside risks. Our sense is these are very low probability events from where we stand today, and that's where we take a leap of faith, and we strongly believe that this is a time for investors to actually increase their allocation to equities as an asset class. I think I will stop here and probably try to address some of the questions if people have. Happy to address them. Pritam, over to you.
Yes, absolutely. I completely agree with you, sir. I 100% agree with you when it comes to capital builder portfolio because that portfolio has behaved really well when it comes to past 1.5 years when the markets were mostly flat, negative. I think it is only possible when you have protected the downside. It is now quite evident how capital builder is able to generate positive returns even in such kind of markets. So I thank you for it was really an insightful session. Getting to know about the data points for e-way bills, PMI with regards to demand was really vital, I believe. So I think our listeners and like myself have taken away meaningful learnings that will support more informed decision making in the markets and will be helpful to ease some nerves. Yeah, so I think we are open for questions. You could just drop the questions if you have any in the Q&A box, and we would take away straight. We take them straight away to the fund manager. In the meanwhile, I have few questions. I think we could start with them. So, Mr. Jigar Shah is asking this question. My question to you is the in the current dynamic world, do you still believe the same buy and hold strategy which you followed since last 12 years or flexible enough to change the stock as and when required? For example, HDFC Bank has given very good returns in last decade, but not since last 3 to 5 years. And still you believe to continue the same. Can you just throw some thoughts on this, sir?
Yeah, hi Jigar. Thank you so much for that question, and it's a very valid question to my mind. Uh, so Jigar, our endeavor is always to invest in businesses where we believe there is compounding, right? So at the time of investing, we always are thinking that if I'm buying this stock, do I want to own this stock for at least 2, 3 years, right? And over these 2, 3 years, if the business is going in the right direction, we are happy to own them for a longer period of time. But that doesn't mean that we buy and we just sleep. We are continuously watching the business, we are continuously evaluating the business. Thanks to the regulators, there is enough amount of disclosures now. We have quarterly results, we have quarterly con calls from the management side. If there are any changes relevant changes between the 2 quarters, again the companies do make those kind of disclosures. And because we select good quality businesses, good quality management, most important, I think our most critical thing that we do is we ensure that the management quality is not at all compromised. So whenever management quality is good, it also ensures that the disclosures are very relevant, disclosures are very, very transparent, and they are always in time. So because of all of this, it always helps us to keep on understanding whether the business is going in the right direction or not. Wherever we feel that the market, that the business is not actually going, the business prognosis has actually not is not playing out or has not played out the way we were anticipating, we would definitely take corrective action. So the 15% churn, sometimes it is 20% churn, is a function of those things. So we are not averse to making changes, but our endeavor is that we want to do the whole fun of investing in equities as an asset class is the game of compounding. So if we can find businesses where that it can happen, we are happy to look at it. So, but as you rightly said, the world is very dynamic, the environment is very dynamic. We have to be very, very agile, we have to be extremely vigilant, and we always take those corrective actions. For example, you mentioned about HDFC Bank. So you must have seen that our weight is today 10% or nearly 10%. But I can promise you, if you just go back to our 18 months, or say maybe, yeah, just about 18 months before our portfolios, our weight in HDFC Bank was less than 5%. We were significantly underweight to the benchmark, right? Because not that the bank was good or bad, bank was always great, but there were two main reasons why we were underweight. One, the valuations were not very comfortable, and we were significantly overweight at that point in time in ICICI Bank. And you know how ICICI Bank has performed over the last 5 7 years. Second, there was a large merger between HDFC and HDFC Bank, which also tells us always that large acquisitions, large mergers always take time to get digested, right? So that's why we were waiting. In the last 18 months, when we saw that now the valuations have become reasonable, the growth is actually coming back, the merger seems to have got digested fairly well, that's when we felt that now the risk adjusted return is on favor, and that's when we actually doubled our allocation, right? So now we are almost 10%, we are full weight out there. So what the point I'm trying to make is that we are fairly active, but we want to be, if I can use this word, we want to be actively passive, right? So, we don't want to do transactions, we don't want to do for the sake of playing the markets, but we want to do it where we believe that where we are adding value, where we believe, like for example, we would have we were owners in a company called Blue Dart. Again, one of the strong franchises, and I'm giving you an example of the last 12 to 15 months or 18 months, right? So we used to own that and we liked the business a lot. But after the first 12 15 months, we realized that there is some structural challenge. It was not a cyclical issue. If it was a cyclical issue, we were happy to still continue with it. But we saw some structural challenge out there as far as the business is concerned. We felt that the industry dynamics are completely changing. There is if you look at in the competitive landscape, although Blue Dart being such a strong franchisee for so many years, and they always had the pricing power, but somewhere something was getting disrupted. And then we realized that a new age business or a new player like delivery is actually getting into that territory and disrupting not only Blue Dart but across the board all the players within that industry. And delivery was doing a great job. That's how we actually got into delivery and we actually exited Blue Dart, right? Similarly, we invested in Federal Bank for many years, but again, there we increased our allocation when we saw some change of management in the last 18 to 24 months, right? So, this kind of, or say when we invested in Eternal, again, there we were one of the early movers after the stock fell sharply from the IPO. I mean, after the listing price in the next 12 to 15 months. So we are always on lookout for new businesses, new opportunities, but we don't want to do any short term investing. Is the point that we are trying to make.
Got it, sir. I hope Jigar sir's question has been answered. Next question is from Devansh Modi, sir. So outlook on the insurance sector given this quarterly results should reflect the GST effect as well as financial year increase in sales due to lower premiums.
See, insurance as a business is a very solid business. If you look at globally, I mean, the best example, if you look at Berkshire Hathaway, they have made tons and tons and tons of money just from the life insurance business and also the general insurance business. So as long as those businesses are run in a very, very disciplined fashion, they will always generate significant amount of cash flows because they are always sitting on floats. The premium that we pay no, that the customers pay them in advance is the float that they always sit on, and that actually creates a significant amount of income for the insurance companies. And as long as the underwriting is in a very disciplined fashion, so that their claim ratio is always lower than the premium that they have collected, as far as they as they can maintain all of this, it's a fantastic business. It's just that in the initial period there are a lot of gestation periods, so one will have to take a very long view of at least maybe 5 7 10 15 years, and that's when you actually start seeing the real benefit as an investor in some of these businesses.
Correct. There is another question from Mr. Shiril Vora. Recently, the IT sector has been facing growth challenges, and the latest results from Wipro, TCS, and HCL Tech suggest continued pressure on demand, margins, and discretionary spending. Given this backdrop, are you considering any changes to the portfolio's IT sector allocation? Specifically, do you see this as a temporary slowdown and buying opportunity, or you're planning to reduce exposure and reallocate towards sectors with stronger near-term visibility?
Yeah, hi Cyril. Thank you so much. Expecting that question from you. Very valid question for the current environment. So, Cyril, clearly, it is the sector which is on our watch list. Since the February month, we've seen this AI tsunami, if I can use that word, which is disrupting this sector. And to my mind, it may disrupt many more sectors, but probably this is first in the line. Yes, there are challenges at this point in time in that sector. The question is it in the price? Is it not in the price? Do we see this as a cyclical thing? Do we see this as a structural thing? These are questions, and this is something that we continue to evaluate. It is very much on our watch list. As far as our allocations in our portfolio is concerned today, I think there is no room to increase allocation there, even if it's attractive because we have decent allocations. If anything, we will probably reduce our allocations and look at allocating where we feel much more confident for the next 2, 3, 4 years. That's how we are thinking at this point in time. But as I said, it's a dynamic situation, so it is on the watch list at this point in time.
A similar question on AI, your view on AI.
So AI is a reality, whether we like it or not. The question is, how do we embrace it, and how do we make it to better our lives is the most important thing. And exactly the same thing applies for businesses. Every business that will try to resist this is going to have a challenge. Every business that will try to embrace it will actually be ahead of the curve in the competitive landscape. As portfolio managers, our job is to find those managements, find those businesses which are going to actually embrace AI, which are going to make AI as an enabler for the businesses to grow and to be ahead of the competition, is something how we are clearly approaching it.
Got it, sir. So there is a question from Mr. Sridhar. Can you please throw some light on the reason for continuing with Mahindra Resorts and Gujarat Power Ports, which have done nothing for the portfolio if I go by the CAGR show? So
Sure.
this
Thank you.
is
Thank you for that question. See, the clear point out here is this is a portfolio is a bunch of stocks. There will always be certain stocks which are doing good, certain stocks doing bad. We always look at the portfolio returns overall, and that is already showcased there. But coming to a very specific question on these two businesses also, see what happens, Sridhar, here is that there are always times when a particular business is doing well. Like even the businesses that you just mentioned, just couple of years back, their returns were not so bad on a CAGR basis. They were giving decent double-digit returns. In the last 12 to 18 months, there has been some change in the management strategy, at least in the leisure business, the vacation ownership business. What we are seeing is that there was a complete change in the management strategy. Now, whether that strategy is good or bad, only time will say. But more important, market is not ready to give its fair recognition till it got validated, and that is why you are seeing some challenges. So we will also have to take certain. I mean, of course, those results are yet to come out, the full year results, and then we will see, discussing with the managements, and we'll take our own call. Again, in some of the other businesses like the infrastructure business that you mentioned, if you see the fundamentally it generates more than 400 500 crores of free cash flow, has more than 5 6% of dividend yield, in fact 100% dividend payout, and almost 4 to 5% of dividend yield. That's the buffer that you have there. But again, there are certain other, I would say, political considerations which is holding the stock price to actually go up, because they need certain renewal of their concession agreement, which should happen any point in time. But till that time happens, probably markets don't want to validate. And again, let me give you an example from our own portfolio. We used to own Apar Industries. We bought it in sometime in 2018. For the next 4 years, the stock after 4 years was down minus 20%. It was literally minus. So if we bought it at say 500 rupees, after 4 years the price was at 400 rupees. We were minus 20%. But over these 4 years, whenever we understood what was happening within the business, what were the and of course during these 4 years the business performance was also not great. But what we were seeing is beyond it. When we were trying to understand that, when we used to interact with the company management, when we used to see the kind of the products that they used to develop, how much they were ahead of the curve, and what was holding them back were all external challenges. Sometime it was the government spending going down in the calendar year 2019 after the new government came in, second half of 2019. I distinctly remember that the government spending in the power sector did not pick up as anticipated. Then 2020 there was a, because they were doing decent, they actually wanted to do decent amount of the export business, and they actually created good customer base within the Western Europe and USA. And then COVID happened, so the freight rates went skyrocket across the board. So in fact, at some point in time when I was discussing with the promoter, he said the freight is more than the value of the product that I have to actually export. How is it going to be viable for me or the customer? We just have to wait it out, right? So we could clearly see that they were doing everything right, but just that because there was no validation of that happening and markets wanted that instant gratification, the stock price was down minus 20%. In the next 18 months, as soon as tide turned, the stock was up 10x, and today it is up actually 20x, right? What I'm trying to tell you is that this is the fun of equity investing, where they don't give you returns in a linear fashion. They make up for it if you are in the right direction.
Got it, sir. I think this question has already been answered, but it is a stock specific question from Mr. Anant Sadana. His question is about HCL Tech facing a lot of flax thoughts. So maybe criticism that has been faced by HCL Tech.
Yeah,
Your
so
thoughts on it,
clearly
sir?
it's a part of the IT tsunami that, I mean, the AI tsunami in the IT sector is what we are clearly seeing. I mean, that is clearly there. And see, this happens once in a while with every sector. It's not that this is happening only with IT today. You would have seen something like this with FMCG some time back. You would have seen something like this with commodities some time back. You would have seen something like this with banking and financial services at some point in time. The question that we have to always keep on asking ourselves, is this structural, is this cyclical? If we believe this is cyclical, and businesses and good quality businesses actually tend to be resilient, and when the headwind turns into a tailwind they emerge even stronger, which is what the example I was giving you about Apar Industries. As soon as the headwinds turned into tailwinds, they emerged even stronger. They started delivering nearly 1,000 crore plus kind of profits, and obviously the market cap from 4,000 went to 20,000, and now probably 40, 50,000, or maybe even higher than that, right? So what I'm trying to tell you is, yes, these are always challenges. Every business goes through a good and a bad cycle. There is no escape from that. This is all cyclical, but sometimes there are structural challenges, and that is where we have to take certain corrective actions, and we are very, very vigilant about it, and will remain agile about it.
Noted, sir. There is another question from Mr. P. Sampath, who wants to understand. He means explain a loss-making deal you have to exit when it is related to the exit strategy in a particular stock, I think.
Sure. So I think it's fairly clear. Like I mentioned earlier, like say I give you an example also, say businesses like Blue Dart, and maybe a couple of other businesses also, wherever we have invested. But when we feel that the business prognosis is actually not playing out in the way that we anticipated, it's not going in the direction that we would like it to be, we are not too much averse to booking losses, because finally what matters is, what is relevant is only future. So where we need to be invested is what is going to do well in the next 12, 18, 24, 36 months. And if we have to bite the bullet, we will do that. We have no qualms about that. we will do the course correction, we will take our corrective action, and we will of course ensure that we don't repeat those same mistakes.
Got it, sir. There are a couple of questions from my side as well, sir. I mean, getting to know about the earnings yield and the 10-year GSEC bond difference, the spread is actually, I'm not being at around 230 basis points, is seems to be positive for the investors. What is that you'd suggest to the investors? Should we deploy it lump sum or staggered way? And if yes, then in how many months?
So, Pritam, my sense is that this is a good time to actually allocate a decent amount of sum. Even if you want to do a STP, I would say do a little higher STP, or maybe you can do 30-40% lump sum and the balance STP. But I think the best person to answer this question will be your wealth managers, because they understand every individual's profile, they understand every individual's asset allocation, where they stand today, and they will be able to guide you the best. But clearly, the risk adjusted returns, the risk reward today is in favor of equities, is what how I would like to say.
Absolutely, sir. Although I mean this question nobody can predict, but still, I mean nobody can answer. But still, how do you assess the current market environment, and I mean what is your outlook on the next 6 to 12 months?
Yeah, see, we strongly believe that the earnings growth will be decent over the next 12 to 18 months. Maybe the first quarter might be still some bit of challenges because of supply chain disruptions, as I was mentioning earlier. But if I see the second quarter, or maybe at least the second half of the financial year FY27, it should be much better as far as the earnings growth is concerned. Valuations are reasonable. Demand drivers continue to remain very, very resilient and very strong at ground levels. So all of this tells us that if somebody is expecting a 13, 14, 15% return in equities over the next 3 years, I think it's a decent expectation. That's how I would like to put it.
Correct, sir. Any change that you're looking to make in the portfolio? I mean, like tweaking your portfolio towards any particular sector or so?
So, Pritham, we are in the midst of an earnings season, and obviously, we will look at earnings across the board. And these are times when we need to be a little bit more vigilant and agile. So, whatever is required, we will take those specific actions. A little early for me to discuss at this point in time.
Absolutely, sir. In terms of earnings growth, sir, I mean, considering the Q4 of the last financial year and the Q1 of the FY27, any earnings growth that you're expecting to be, I mean, impacted?
See, my sense is Q4 will not be so much impacted, barring maybe a few exceptional companies which might have got directly impacted because of the war. Say, for example, if somebody was importing LPG, then yes, they will have a direct impact in the month of March. But other than that, I don't think there has been too much of an impact. Q1, yes, we may see some impact, particularly on the raw material inflation side. That may have some impact on the margins or profitability of some of the companies, because it's not easy to pass through the entire cost inflation in a very short period, and in fact it's not even wise to do that, because that kills demand. One has to gradually pass through to the cost inflation, and hopefully by then actually the oil prices may actually cool off, and the cost inflation may also recede quite significantly. So I think that even if there is a challenge, it may be a challenge of a quarter or two, not more. That's how we are thinking at this point in time.
Got it, sir. Last question from my side, sir. As you rightly mentioned, rupees expected to be appreciated. Do we see FIs coming back to India? Few years back, like I remember, FIs were owning some 22% of India. Today, they are owning only 15% of it. And the significant contribution that has been come from DIs that we have seen. Do you think the importance of FIs are slightly shifting towards now to DI participation?
No, I think that most important thing is that today Indian economy offers one of the highest, or probably the highest growth as a country level, GDP growth, compared to all the other countries in the world, right? Uh, if we remain at this for the next maybe say 2 quarters, 3 quarters, 4 quarters, 6 quarters, 8 quarters, our GDP growth, our Indian corporate earnings growth continues to be very, very strong and healthy. Because we have to understand that our growth rates are very, very high quality growth at an India at a country level compared to many other countries. Our return ratios are very strong. Our growth ratios are going to be high quality growth ratios. If that actually, and which is again a good probability because that will happen, and because we will stand out versus most of the other, or rather all the other global economies. Uh, I don't think we have to worry about FPI flow, whether they are coming or not. It's just a question of how quickly. So, because eventually money is always going to chase growth, when it comes to equity investing. So, they will come to India. I have absolutely no doubt about it.
Noted, sir. I think we don't have any questions. I believe we can conclude the session. Thank you so much, Sachin sir, for sharing such valuable insights and perspectives and navigating us right in the right direction that is much needed in the current markets. I'm sure, along with me, our listeners have also gained meaningful takeaways that will help them approach their investment journey in more informed manner. To all our participants, thank you for taking time to join us today. We truly appreciate your presence and participation. On that note, we conclude today's webinar. Thank you so much. Have a great evening. Bye.
Thank you, everyone. Thank you, Pritam. Have a great
Thank
evening.
you so much.